Hi, Alexander Nikolov is here from trendrecognition.com. Today I'm going to take a look at the Forex market, and particularly I'm going to discuss with you potential change in trend in USD Japanese yen rate. This is the chart of dollar yen, the weekly chart, and as you can see here, the trend is on the weekly chart is weak downtrend by our methodology. Weak downtrend means that the price is well below the 100-week moving average. This is the blue line. But as you can see, the price is touching or sometimes moves above the 21-week moving average, which itself sometimes trends lower, sometimes trends higher, sometimes trends sideways. And when you have this kind of setup, a declining 100-bar moving average, and the price is well below the 100-bar moving average, but is crossing many times the 21-bar moving average, then the trend is weak downtrend. And when you have a weak downtrend, the best way to approach the market is to sell the rallies toward the 100-week moving average. So every time the dollar-yen pair rises up toward the 100-week moving average, it's good to consider a short position, particularly when the weekly stochastic gets overbought, and this always comes when there is a huge rally toward the 100-week moving average. So this is the best strategy to apply in a weak downtrending market, to sell the rallies toward the 100-week moving average. And of course, if you are more aggressive, because the trend is not strong, the downtrend is not strong, you can also try to buy on weakness after the weekly stochastics get oversold, and then gives a buy signal by crossing the 20% line. So that's the usual approach one can follow. The readers of our site know that since the launch of the site in May 2009, we've been following a diametric formation here. I'll go to our website. This is the weekly count of dollar-yen. This is the weekly chart. And you see the diametric formation that we've been following for more than a year. And it guided us very well for the past year or so. We attempted several short trades in this market. So going back to the current chart, you can notice that the weak downtrend has weakened further in the past several months, as the down moves has been able to make only slightly marginal new lows on each attempt on the downside. So that means, and considering the wave structure A, B, C, D, E, F, G, the last leg of the diametric formation, that means that sometime in the fall of this year, the market will likely reverse and a new trend will start to the upside. How this can be justified from a macroeconomic point of view, I don't know, but that's not important. The chart tells us that it is highly likely that the weak downtrend here may soon change to another trend, and this is another bull market here. How far the potential bull market can go? Well, it can go up to 108, 110 area, where the 62% retracement of the entire bear market is located. So a huge move lasting several months or possibly years on the upside is likely to start sometime in the fall of this year. How can we confirm that the trend has changed? Well, now we need to see some basing here, some sideways consolidation first, and then we need to see a break above this year's stop, which is roughly at 95 level, and above the 100-week moving average. That will confirm a trend change on the weekly chart to the upside. And now let me go briefly to the euro-dollar chart, just to address the large rally of the single currency that we've seen for the past 2 months or so. You can see a completed flat ABC flat pattern here from the 2008 top, which means that the euro may have already reversed to the upside. If you take a look at the chart of dollar Swiss franc, you can see that the Swiss franc is even stronger than the euro, and the move from the late May low in the Swiss franc dollar chart is much stronger. So these are bullish signs. However, I don't like the V bottoms. They are quite rare in the reality. So I don't like this kind of a bottom here. That's why I'm not bullish yet for the euro. What I expect to see here is some further rally of the single currency, possibly to 132, 135 area as a maximum, and then another decline, and then another rally. So some sideways consolidation is likely to develop here for several months, but then I would expect to see another plunge of the European currency. Why? Because if we take a look at the bigger picture here, this is the entire rally from early 2002. You can see this rally from 2002 to 2008 top is clearly corrective. So that means that most likely such a move is to be retraced at least by 2/3. That means by 62%. So if you take a 62% Fibonacci retracement, that brings values around 113, 114 area. So despite the strong rally of the single currency, here I'm not bullish yet. Not bullish yet. I expect some sideways consolidation and then another break lower later this year. What can change this view is a rally above 135. Really, if the euro is strong enough to move above 135, then I may consider a much more important low here around 119 area. But for now, I'm neutral to slightly bearish for the medium term on this pair. Thanks for watching, and I'll be talking to you later.